If you own a broad market index ETF, you might think you're diversified across thousands of companies around the world. And on paper, you are. But right now, a huge and growing slice of that portfolio is quietly riding on one bet: that a handful of AI companies keep growing at an almost impossible pace. And if that bet is wrong, your diversified fund is a lot less diversified than you think. Here's why this matters right now. Markets have been hitting fresh highs, but underneath the surface, something strange is happening. Even on days when the index closes up, more stocks are falling than rising. That's called weak market breadth, and it usually means gains are being carried by a small group of giant companies rather than the market as a whole. Analysts are openly using the word frothy to describe expectations around AI infrastructure spending. When professional investors start using words like that publicly, in earnings calls and market commentary, it's worth pausing and actually understanding what's inside your fund, rather than assuming a rising index means your risk is evenly spread. So let's start with what a typical broad market index ETF actually holds. These funds are market cap weighted, which means the biggest companies make up the biggest slice, automatically, without anyone deciding that on purpose. There's no fund manager choosing to load up on any single sector. It's just a mechanical rule. Bigger company, bigger weight. Over the last few years, as a handful of companies have grown into some of the largest in the world on the back of AI spending, they've also grown into a much larger share of every major index fund built around the US and global markets. This isn't a flaw in the index. It's just what market cap weighting does by design. But it means the stocks portion of your portfolio is more concentrated in AI-adjacent megacaps than at almost any point in the last 2 decades, even though you never made an active decision to bet on any one theme or sector. Here's the part most people don't realize. You didn't choose this concentration. You bought a fund because you wanted broad, low-cost exposure to the global economy, spread across thousands of companies and dozens of countries. But as this handful of companies has surged in value, they've pulled an outsized share of your fund's performance along with them. Right now, a meaningful chunk of the total return you've seen in a standard global equity ETF over the past couple of years has come specifically from a small handful of AI-related megacaps, not from the broad economic growth you might picture when you think about the market. That's not necessarily bad, but it does mean your risk isn't evenly spread the way it might feel like it is, and it's worth knowing that before something changes. So what happens if AI spending expectations come back down to earth? This isn't a prediction, and it's not a call to panic. It's a scenario worth understanding so it doesn't blindside you later. If a handful of companies make up an outsized share of the index, and their valuations are already pricing in years of near-perfect execution, then any disappointment in earnings, spending plans, or growth forecasts can drag the entire index down disproportionately, even if the rest of the economy is doing fine. This is exactly what market concentration risk looks like in practice. It's the same basic dynamic that played out during the dot-com era in 2000, just with different companies, a different technology story, and 2.5 decades of hindsight we didn't have back then. Now here's where the evidence-based approach actually helps you make sense of this instead of just reacting to it. This is not a signal to sell your index funds, panic, or try to time an exit before some imagined top. The data on market timing is remarkably consistent year after year, across almost every market cycle. The vast majority of actively managed funds that try to sidestep this kind of concentration risk still underperform the index over the long run, according to the SPIVA scorecards published every single year. Trying to guess when a bubble pops and get out just before it does is a strategy that fails far more often than it succeeds, even for professional money managers with entire research teams. What the evidence actually supports instead is staying diversified globally, understanding exactly what you own, and not making emotional decisions based on headlines or short-term volatility. So here's what to actually do with this information practically this week. First, understand your exposure. Look at the top 10 holdings in your ETF's fact sheet, whichever provider you use, whether that's a Canadian all-in-one fund or a US-listed ETF. It takes about 2 minutes, and it will show you exactly how concentrated you currently are in a small number of companies and how much that's shifted over the past year or two. Second, resist the urge to make a bigger, reactive move based on a headline or a YouTube video, including this one. If you're a long-term, globally diversified investor already holding an all-in-one index ETF inside your TFSA or RRSP, the right response to concentration risk is not usually to sell everything and chase whatever seems safer this month. It's to keep contributing on schedule, stay invested through the noise, and let the diversification you already have do its job over time, the way it's designed to. Third, if concentration genuinely concerns you, after actually looking at your holdings, the evidence-based response isn't picking individual stocks to avoid or trying to underweight specific companies yourself. It's making sure your overall portfolio still matches your actual risk tolerance and time horizon, and in some cases, considering a small allocation tilt towards small cap value, which has historically behaved differently than mega cap growth stocks during periods like this, giving your portfolio a source of return that isn't as tied to the AI trade specifically. The takeaway here isn't fear, it's awareness. Owning an index fund doesn't mean opting out of market cycles. It means riding them out with lower costs, broader diversification, and better long-term odds than almost any alternative approach, including trying to pick your way around this specific risk. If this helped you understand what's actually inside your portfolio, subscribe for more evidence-based breakdowns of what's really happening in your investments without the hype or the fear-mongering. And if you want to see how this kind of concentration risk shows up differently across fund structures, check out the video I've linked comparing some of the most popular all-in-one ETFs, because how much of this exposure you actually want and how it fits your goals depends on which one you're holding and why.